Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Drew Meredith, how you doing?
Pretty good. I thought I was going to have to do the intro then.
We kind of just froze. Have you got your Tesla yet?
No, but we're getting closer. We're getting much closer. Every time I go to the petrol station and fill up for another $150, which seems to be at least once a week at the moment, it's getting closer and closer. When you think, I think the novated lease cost of a Tesla is like $600 per. Is that per month?
It's whatever it is. It's not bad. You can even because when you buy the Tesla online, you buy it all. You don't have to buy it online, but it's easier. You can select Macquarie financing, whatever, blah, 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 blah. And it's actually, it's crazy.
Add $2,000 in servicing, add $3,000 in brakes, add $1,000 a month in petrol.
Sounds like everyone, we've got him over the line. Good news for Tesla shareholders. The mighty,
just one.
The heir to the Meredith goat's cheese fortune is moving into Tesla in a big way.
We are not heir to the Meredith goat's cheese fortune. Certainly not.
It's Meredith goat's cheese.
Meredith's the town. I'm pretty sure it'd be owned by like a Smith.
Okay, let's find out. Meredith goat's cheese owner.
I'm guessing Peter Smith. Let's go with Peter Smith.
Close. Sandy and Julie Cameron.
Oh, all right.
Yeah, I mean, Cameron's right next to Smith in the dictionary. Anyway, so that makes sense. Shout out to Tim on the community who went deep into the cost of Tesla, and he shared a photo of his 2 Teslas parked in the driveway. He's got the Y and the 3.
Yeah.
It was a bit of a gotcha headline, the hidden cost of a Tesla, and then says,
"Gotcha."
Why it's so good. Shout out to Tim. But that's interesting.
We call that clickbait in the industry, don't we?
Yeah, we call that. Tim's leading the charge. Shout out. But great post if you're interested. Maybe it's worth just quickly explaining for anyone that is thinking of a car, the idea of a novated lease or what that is.
I still don't completely, and this probably sounds bad as a financial advisor, completely understand it, mainly because they've never, we run our own business, so it's not something we offer broadly. We do it for ourselves. We might do it for ourselves. We never have. But my understanding is essentially you get to package up everything like maintenance, fuel, your lease and everything into a pre-tax or to be deducted from your salary, not necessarily if it is pre-tax. The key is that for pretty much every car apart from EVs, you actually have to gross up the expenses of the car for fringe benefits tax because you're getting a benefit. And I think that's a 48% rate or something. So then there's actually no significant benefit. But if it's FBT free, which EVs are at the moment because they're trying to incentivize people to drive them, then it is significant. It can be a great tax saving. Yeah. Hopefully that was the best explanation.
That's actually really good for someone that came into that saying, I don't really know that much about it. That was really good, yeah. And it's basically like just packaging up the value of a car.
Yeah.
But I think it's a bit of the benefit of one of the benefits of owning a business is that you can buy vehicles, like if you're a tradie.
An ABN.
Under your ABN, but you still, under the law, have to apportion how much of that is private use versus business use.
Yeah.
Whether or not everyone does that, let's be honest.
Not the Australian Tax Agents podcast.
No. But so if you're in like a corporate, how do you get some sort of advantage? So the industry's kind of come out with this idea of a novated lease where you can kind of package everything, you can take it out of your pay. Whether or not it's that good of a deal remains to be seen. But with the added benefit of the government trying to get people to drive electric vehicles, a lot of the math and the complicated stuff that goes into a novated lease is kind of like done away with. So there's a significant benefit for people to look at EVs right now. And I don't think that will be around forever, to be honest. I don't think the government will want that for too much longer. So
they got big discounts and you're getting incentivized rates on the leases attached to cars as well, which is,
Yeah, because the the banks and that who provide those loans can call them green loans.
They're incentivized, and then they can, they're subsidized, I'm pretty sure, for offering more green loans too.
Yeah, they're
Like a
responsible.
no-brainer, basically. So you can have one
So
on
what's
two. I went into the last 3 weeks thinking about buying one car, and now I'm looking at buying two.
I told you, mate. You get two for the price of one.
Yeah.
Jamie, if Jamie gets, Jamie's going to get one for sure. Jamie.
Yeah, if I do, he will.
I think he's going to do that. Are we at the top of the market, Drew?
There's every chance we are.
Yeah.
I mean, we're at the top for any point in history at the moment. So
Yeah.
we seem to be hitting that every day. And this is a topic that's coming up regularly. And it's probably really relevant for, as you've probably seen, there's a lot of people who invest in like one or two ETFs when they're trying to build wealth. And that's great. But if the ASX at 8,500 points is at a peak like it was, it's taken, I think it took 10 years to get back to the highs before the GFC. So there's every risk, and there's a risk at any point, not just now, that the market could go sideways for an extended period of time. We don't always have to talk about a crash, and we know crashes tend to be shorter than ever now, but there's a potential for markets to go sideways, and there always are when you're hitting all-time highs. But there's a growing chorus of concerns about valuations.
There is. What do you think? It took a long time to get back to the highs, not including dividends.
Dividends were cut too.
Yeah, true. Big way. I'd just say I had this conversation. You know how you're on the Get Rich Slow podcast with Anna and Tash recently? They came in the other day and we're talking about this, and I kind of took some of your knowledge and I applied it like a chauffeur.
Similar to what I would do with Jamie.
You just take Jamie's knowledge and pass it over your own.
If I say something in here, I know it ends up on a podcast.
So I don't think that it is sensible to have all of your money in one or two strategies that are particularly market cap weighted strategies. Like,
that scares me. That's one thing that scares me.
Yeah, because we just don't know. Like we know that over 20 or 30 years, stock markets have tended to go up, and the ones that have tended to do well are the market cap weighted traditional stock market index funds.
Yeah.
That doesn't mean that they're always going to work. And I think particularly for your demographic, well, and mine too, is like you can make a lot of mistakes into retirement or in retirement, can't you? When you got all this money and all of a sudden things have started to fall, you make bad decisions. Even if the long-term strategy is good, the short-term ride is stressful.
I'll guarantee, well, I'd say guarantee, but if the ASX fell 40%, a lot of people holding to ETFs and the ASX fell 40%, well, the US is probably going to fall 30%. And this has happened twice in the last 20 years. So every chance it happens in lead up to retirement. Yeah. So many people, I'd say half the people will sell at the bottom. So, because what happens is even the people that you think are the most experienced, the most, understand risk, it's, I need to protect what I've got left. It happens all the time. And there's two ways.
It's rational to do that, right?
You can rationalize that very easily because, now I've got 40% less money than I had before. I need to protect what I've got and put it into term deposits. And we know, and everyone knows in the back of the head, it's exactly the wrong thing to do. And there's two ways to deal with that. One is, I think we both do it a lot, which is where your Rask Invest portfolio focuses, and where a lot of our focus is you use asset allocation. So instead of having two ETFs that track two indices, you might have 10 that track not just the main indices, but start to invest in other asset classes, infrastructure, fixed income. And everyone hates fixed income, doesn't understand bonds. Why would I hold them? But this is exactly why, having, using that asset allocation to help you make better decisions, not necessarily just for the returns. And then blending some, for us in retirement, we blend some active management in as well. Because we've seen active management may not always keep up when the index and 3 stocks are doing incredibly well. But historically they've done well during periods of volatility and during periods of stress. And the expectation should be that they will fall less during periods of difficulty than the index.
We should be very clear. We're not saying for people to sell out. A lot of people take what some experts oh, they're negative, therefore I should sell everything. No, that's not what we're saying. What we say is your money has to go somewhere in the mix of it, particularly in retirement. You need to think more carefully than just, I'm just going to be 100% growth because it's a great idea. Yeah, on a spreadsheet, it probably looks great for 30 years in historical terms, but maybe it's not the right thing. And I've been thinking about that bonds comment. This year, like we've been pretty heavy into just standard government bonds, like through IAF and VBND and these types of things. We have a bit of cash, which kind of acts like a floating rate, but this year, this year people were like, I feel like I've got tired with that. They're like, well, why you do that? Why don't you just be 100% shares?
Yeah. And
even like you question yourself, you're like, well, yeah, it sucks because bonds have only gone up maybe a couple of percent.
But that's recency bias.
Yeah. And you think to yourself, well, yeah, of course, this guy over here is looking great because he's got 100% NASDAQ.
Yeah.
He's got Apple, he's got NVIDIA, like he's doing all right.
And I think there's this expectation now that you're going to keep getting the same returns you've had for the last 3 or 4 years. And every conversation I have, whether it's a new client or an existing client, it's always about this isn't what you should expect every year.
Yeah,
this is
especially the last 12 months. Wow.
It sounds, but I think that's the key. And it's like if you're running an ASX listed company, you can't let your share price get ahead of itself too far and ahead of what true earnings expectations are. You need to manage expectations and manage growth prospects as much as you can.
Actually, we had Heath write in. Heath's investment advisor. Shout out to Heath. He wrote in a few weeks ago about this, and he said it's not uncommon. Double negative. It's not uncommon for, I think he said the NASDAQ to go up more than 20% in a year or something like this. Sorry, Heath. But it just doesn't happen that often that people think it's normal. So it does happen, but then you've got to remember that if it goes up 20% one year, it could be down 10% the next.
Yeah.
And that's how you get a long-term average. You actually said something in your notes for today, which was interesting. So you get a lot of questions. You said you get a lot of questions about the difference between upfront and ongoing advice. But then you said something in here. The value of advice seen as much as 1.5% to 2% outside of investments. What, just tell me.
There's a challenge in, and the biggest thing for advisors is being able to show the value of ongoing advice. And the idea there is that the cost of ongoing advice is clear. Like you get offered, and this is what it is, and then you can say, I'm going to pay this for 25 years, and it adds up. It continues to add up over 25 years. But as a client and for someone that hasn't had financial advice before, you don't see the dollar or psychology or any benefit when you're starting that process. But there have been quite a few white papers produced by fund managers, interestingly, not financial advisors, that actually show that in multiple ways, whether it's like rebalancing, which is something you and I, our firms do a lot, or helping people from selling, stopping people from selling, tax benefits, all these other things, that the value of financial advice is generally calculated to be at least 1.5 to 2% of your portfolio of what's being managed every year on average over the long term. And you think about that. So if you're getting an extra, 2% return on $1 million portfolio, you're talking about a $20,000 benefit every year. And in most cases, that's going to more than pay for, well more than pay for the cost of managing that portfolio or the cost of ongoing financial advice that you'd be paying for it.
Yeah. Yeah. We spoke about that big tax saving someone had ages ago. You also said something else in this, which I'm not buttering you bread.
I'm going to go through my notes.
You said if you get 2% outperformance like we have, then it pays for itself, but it goes beyond that, which you just mentioned. So the Waddle portfolio, which historically, like you, Jamie, the team, but also more recently Atchison's have been involved. Yeah. Do you ever, like obviously Atchison's would, but where does that come from? Like where does the outperformance come from?
Almost entirely through asset allocation and rebalancing. A lot of work goes into the underlying investments at the bottom, naturally, but more of that work is how they blend together and are they being true to label of what they are and what we want. But we have the benefit of Atchison's, the amount of detailed work they can go into and the amount of data they have to actually analyse which decisions have made the most impact. and it's the rebalancing impact and the asset allocation. So what asset class you hold during any period are the difference between, and we compare that to, say, a passive. So we'll compare it to a completely passive a similar strategic asset allocation position as the reference portfolio.
Yeah. Interesting.
And you find that consistently. Like you could show that if someone who's doing it themselves and has 80% in shares and 20% in term deposit, you'd end up showing that their issue has been asset allocation, that they've detracted from returns because of they haven't had overseas, they haven't had infrastructure, they haven't had fixed income.
So it can cut both ways.
That's why they say 98% of returns come from your asset allocation decision, not your investment selection.
Yeah. Yeah, it's fascinating, isn't it? Okay. You did, I was bamboozled by this chart at first that you shared, but I think this is like one of the things like with your audience, but also like at Waddle, but also just in general with like the people I deal with and people like me, like a quote unquote younger-ish person. I feel someone said, one of the reasons I like you is because you seem younger. And I'm like, yeah, but I feel older than you, sir. But the ability to like calculate from a financial planner or just in general, like if someone has some whiz bang tool, to be able to calculate what the expected income is as they mature through life is like probably the most powerful thing.
Yeah, incredibly.
So talk us through what you found.
So one thing Waddle's working on is a life expectancy calculator as well. How many years are you expected to live after you retire? And interesting, like all life expectancy tables you can access are generally incredibly old, but Die with Zero is big on this, and quite a few. I spoke to Beck Wilson. She's exactly the same, which is if you go and look at how long you're going to live when you're 60, I think there's like a 50% probability you live more than 90. So that's, and every time we put a YouTube video up about retirement, when you're going to retire, it's like, that's rubbish. I was going to put a couple of swear words in there. It's only 10 or 15 years. Everyone dies in the early 80s. And like the data and the actuaries are showing that it's more likely in your 90s. And once you realize that means you got 25 to 30 years of investment or of concern or of income need that you're going to have, and that can completely reframe your decision and probably the question of whether you need advice or not, but why you need to be more active and involved in managing your money. But the charts I put in were courtesy of Superguide, so I think you've yeah. So they use, but I believe they use like one of Telstra's or someone else's lifetime income calculator. And I thought this was super interesting. So it actually compares the amount of income you can draw from your portfolio based on different levels of investment risk that you're taking. So we're looking at how long $1 million will last you in different outcomes for retiree. So let's say you're retiring at 65 and you're expecting to live so as we'll talk about, your average retirement age is about average life expectancy is just over 90. So retiring at 65, a couple can draw $66,000, assuming they live for 30 years, $66,000 per annum from $1 million portfolio if they invested solely in cash. Now you go to the other end of the spectrum, and 66 is about the ask for comfortable retirement standard. So it's very base level on $1 million. If you go to the other end of the spectrum, if you had a growth oriented portfolio, you can actually draw $78,000 per annum from your portfolio of $1 million every year, and run out at 95 years of age. And this uses, as we're talking about, some lifetime income calculator. I think it's Telstra or one of the major superannuation funds.
Telstra, I believe. Telstra lifetime income calculator, is it? And
that's 78,000. The growth portfolio is like 20% in low risk, 80% in growth assets like shares. And then the moderate, probably in the middle, would be 50-50 or thereabouts. So 50% in each. And that's $76,000 per year. So, and $12,000 per year, solely because you're being a bit more diversified and including, and as we talk about, income plus growth is total return. $12,000 a year is significant. That's about 20% more than the base level, and can be a significant different outcome. That's it's probably an international trip. every year for 30 years. Not that you'd probably do it every year for 30 years. But I thought that was super interesting. And then obviously it changed a little bit depending on how long you want to put your life expectancy in there. And it for $2 million, the numbers are similarly, probably even more stark, I'd suggest. Whereas if you're living to 95, you can draw $81,000 if you're invested in cash, or $108,000 if you're invested in a growth portfolio.
So basically, the moral of this story is what you're saying is, again, we've seen that you must invest beyond just the really conservative option.
Yeah.
If you want your money to last longer. But that is so counterintuitive for people because they're like, I'm in retirement, I need safety.
Income.
I'm just thinking of like all the retirees that I know. They're like, I need safety. I don't understand the stock market. Hence,
yeah,
we'll come back to that advice thing actually.
And so much of that comes from growth, to be honest, because
you got to grow it for 10 years time, right?
And you think until recently, holding banking shares in Australia for income, you'd actually gone nowhere for like 15 years. The share price were the same as they were in 2006 until the last kind of 12 months. So you could include like investing in bank shares probably in the cash one because you're effectively just getting an income source. I thought, and that's $27,000 a year different for someone with $2 million, and these are really significant outcomes. So we're working on our own calculators for these as well.
Yeah, good luck with that. There's a lot of regulation around it.
Let's be clear, I'm not doing that. It's not something I can do.
I've tried building them before.
I outsourced to other professionals.
Yeah, I've tried building them before, and there's a whole line of ASIC literature and regulation around retirement calculators, and I just thought I'm not gonna.
No,
I can't. The good news: Bitcoin hit its $100,000 US. Everyone can retire.
It's happening again, though. I can't explain how many people are calling, wanting to buy Bitcoin again.
Okay, Bitcoin in US, not USB, Owen, USD, $98,898. That seems like a lot of nines and eights. In Australia, whoa, it has popped.
It's probably a sign.
In Australian dollars, I could probably bring this up for folks that are watching on YouTube. That's Tim's Tesla. We'll show that. Why not? There it is. So $153,000. If you're not fully invested in Bitcoin at this stage, you're not even living. That's what I'd say. Do you do your bloody modeling, Drew?
Oh, that's retirement. Big part of that's the AUD, though, isn't it? That last little kick.
Big Aussie dollar, mate.
We're back at 64 cents, aren't we?
But if you look, like even in USDs, mate, the big UEDs, look at that. Yeah. So anyway, if you just invested in Bitcoin, you'll be fine in retirement.
Yeah. Yeah. You can say the same about ASX or the NASDAQ too, can't you?
Yeah.
It still defies, I don't know, any kind of, I don't even know how to say. Have you got any Bitcoin in the Rask Invest portfolio yet?
No. But this is the thing, right? Like, what's the old saying that like, just something can remain, can go up longer than you can remain solvent? Like,
you'd hate to be shorting Bitcoin at this point.
But I just feel like Bitcoin is going to keep going up just because there are people out there that feel like they have to buy it because it keeps going up. Like it just feels like one massive Ponzi scheme.
Felt like it last time too.
But like when you have like ETFs and stuff launching and to be honest with you, Drew, like it's got to the point where it's almost like as asset allocators, you need to have a very small slither in a portfolio just because you've got to almost
put questions.
Hey,
and that's always a good reason to have an asset in a portfolio.
but my point is like, when you build, like, it's like the old gold debate, right? Really, anyone who buys gold is buying it because they think some other geezer is going to pay them more in the future. It has no basis in reality. But the fact is it goes up because people think it goes up.
Yeah.
And eventually logic is outweighed by a spreadsheet because the spreadsheet eventually starts to show things like, well, correlation over the past 5 years is this, total returns over this period of that. And then you're just like, I get all that stuff, but it doesn't actually make any sense why anyone would invest in gold. Like other than for the use case, which is a very, very, very small subset of the actual gold produced. Of the gold produced, like most of it is just sitting in vaults collecting dust.
Yeah.
And so I think we're seeing like the new generation of that with Bitcoin is people like, well, you got to do something. So I don't know, like in the Raise, I caught with Brendan from Raise this week, Raise Invest.
Not in an Uber.
No, he was in my, shout out to Apex Car Hire on the Gold Coast. He was in my Apex Car Hire a few weeks ago. You're welcome, Brendan. But it's more like
Waymo your cash. No, what's it called? Venmo.
Zeitgeist. Yeah, it's. He said that like I think they were the first to have Bitcoin in an allocation, like physical Bitcoin, and that's worked really well for them. And for anyone that's held it, it's worked really well. But I don't know. It's just one of those things. Who knows where it goes next? Another note which I thought was interesting before we get to some questions, there's probably 3 pieces of information I want to cover real quick here, Drew. One is you said data is king at Wesfarmers, and I was thinking, why did you say that in our notes? Because I don't know what you're talking about. Like, isn't it like data is king? Are you talking about like the new OnePass thing that they offer where you can get Kmart, Officeworks, Bunnings all in one kind of subscription thing?
Yeah, I signed up to OnePass too.
Did you really?
Yeah. I mean, it's like
OnePass
$20 free shipping and all those kind of additional benefits on it. And Kmart has some great homewares. Shout out to Kmart.
Shout out Kmart. Yeah. Homeco.
No, it was more about so they elevated, I think it was the head of data to run the Kmart discount department. I thought that was super interesting. And you're kind of seeing this in multiple businesses. I can't remember if it was Ramsay Healthcare or Woolworths, and like the biggest part of these loyalty programs is data and being able to use and harness that data. And a lot of these new management decisions are coming from less traditional, whether it's a grocery retailer, whether it's a healthcare company, they're coming from less traditional sources because they need to understand more about their customer and how to adjust their business on the fly to obviously make more money, or make sure they're providing a better client experience at the other end. So I thought that was super interesting that they've promoted someone that was very focused on data to be running the Kmart division.
I think that's great. Yeah,
Alexandra Spasica. Yeah. All right. Yeah. I'm sorry. Apologies, Alexandra.
We want to get Alexandra on the show. Now we've just ruined it completely. We'll just go Alex.
Get something listening to it so they can reach out and correct that. Yep.
Launched by Federal Minister for Women and Finance, Katie Gallagher, in Sydney on Wednesday, the Future Generations Women Fund has nabbed $100 million in seed funding from Nicola and Andrew Forrest Minderoo Foundation, end quote, Drew Meredith's Google Doc. This is really great because we love the people at Future Generation.
Yeah.
We're a pro bono partner, and I was speaking to Caroline Gurney quite a few months ago about this fund, which is all female fund managers. At the moment, Drew, I'm not saying it's all in a fund, but I think Caroline's probably going to be like, Owen, you shouldn't have said that. In the future, it will be more broad. Everyone will be able to start to invest in it, which is great. So
this is the one that's currently there's a listed investment company and there's a portion managed by 5 different fund managers, and this is the idea that female fund managers are going to manage a 5, 6, however many there are, a portion of that wealth of that pool of capital.
I think this is all female fund managers. I could be mistaken, but this is
for this one. Yeah, but the existing one.
The other ones, the other ones have some.
60 managers, yeah.
So yeah, there's the 2 Future Generation funds. There's the global and the Aussie, and like people don't always love the listed investment company structure because of the fees. And so what they do is the fund managers rebate their fees, the service providers, all that sort of stuff, rebate their fees. So it effectively brings down the cost to virtually nothing, and anything that would be, fees traditionally is like 1% is paid to the charities. And that's the model. And I think that this is only the start of something bigger in the future, like 10 years from now. We'll look back and say, yeah, the Future Generation funds are great as listed investment companies, but can they bring other types of vehicles that suit different investors in different ways to the market? And I think this is the start of that, I think, which is great for them. So shout out to them. Larry Diamond to leave Zip, 3 exclamation marks. Working on his charity, says Drew. Now, Drew is a long-time hodler of Zipco shares. Let's just
not by choice.
Not by
You're
choice.
calling me foundation bro. I think Jamie and I got called advice bros this week. Or
Yeah, on
pin
YouTube. Yeah. Oh, that was funny. And then someone said on your YouTube something about, I don't know, something about you guys like, I don't know, it was something.
ACA.
Gotta love YouTube comments.
Yeah.
This is the zip code. Okay, that's not good. Over 1 year, up 700%. Larry Diamond, co-founder, I believe, or founder, Drew? Co-founder?
Going to the moon.
Going to the moon, you reckon? So
Yeah,
next
co-founder. I think he sold 30, what's that?
30 million
$100 million worth of shares? 100 million?
Yeah, he sold $100 million of shares a few days ago.
Going to wait,
Which is fine because he's got heaps of shares. Like, he's all right.
He's fine.
Yeah. But he's been with the company a very long time. I was thinking about him stepping back, and the business is pretty well established now in terms of its people.
Yeah. On average, his shares were probably bought at like 20 cents a share. So,
yeah. He would have gone through the ringer over the last 3 or 4 years with the dramatic rise, and then crash down and buy now, pay later. That would have been harrowing as an experience, I feel.
Yeah, for sure. Yeah, and having less
Why
and
is
less
the
control
second
over your
largest
business
shareholder? I'm sure you've felt this.
Yeah, that's where these wrinkles are coming from.
But it's back, baby. Zip's on the way up. I feel like, he's sold some shares. He's probably going to be able to use that money now, start what they call a family office, Drew.
Yeah.
That sort of a thing.
New companies. Yeah.
Yeah. In other sell down news, Pro Medicus' founders, Anthony and Sam, sold, I think it was 1 million shares of Pro Medicus, but given the share price is currently around about $268, if you sell 1 million shares at let's say $258, that's a lot of dollars.
$258 million. What's the tax on that?
I always think about that. Like, if you've got that much
$129 million in tax,
you got 4 CGT.
Yeah.
Like, you got
no carried forward losses on that.
No, I don't think you're going to have much to offset that.
Maybe the shares in Zip you've got might do a little bit of a loss on the other side, but
that's a lot of moolah to pay to the tax office. But that's the whole point, right? So that's great. And let's be real. I think the Pro Medicus co-founders, disclosure, I do own a small amount of shares. Over the long term, they've been incredibly diligent and incredibly respectful of investors in the way that they've said, we're selling a small portion of shares, which for us, it seems like a lot, but for them, they've still got over 40, I think I've got in my notes 46%, don't quote me on that, but it's somewhere around that. And reality is, like, they're people too, and they see their portfolio and probably want to diversify a bit. I remember we asked Sam that question at our Rask event a couple of years ago, and he said, basically all my money's in Pro Medicus. So he's like, I have to think about that as well. So, I think that's just reasonable. And the fact that they could sell it to fundies.
Like, you're a billionaire, but it's all in stock. Like, any natural person would be like, oh, I've got 90% of my wealth, 98% of my wealth in a single company. But then if you're seen to be selling, it's a negative for the share price. So you get trapped in this they're billionaires, so you can't really complain too much, but you get trapped in this position. And hopefully, you hope that the share price continues to go up. But at some point, and this will be the challenge for them, is at some point they're not going to be in control of the company, and they're still going to be the largest shareholder. So there has to be a lot of trust in the next management team that comes in.
It's like when people jump into Google like this, Drew, we're just here in Google, and we go, Elon Musk net worth, whoa, $336 billion US.
It's 500 billion, isn't it? Yeah.
But they see that and they're like, imagine having that amount of money in a bank account. But they don't have that money in a bank account. That's in Tesla shares, SpaceX shares, and a bunch of those other random little things he's got, I'm sure. A very, very, very small portion of that would probably be in things like property, but it's all in his version of a brokerage account.
Yeah. You could actually see shares there. Imagine. Do you reckon they had to put new extra 00, have
The developers would have had to rewrite the brokerage
how many
account.
commas is that? 4 commas? 3 commas? No, he's not at 4 commas yet. It's 3 commas.
We have to adjust the screen size just to get in the number. Yeah, wild, absolutely wild. Actually, we caught up with 2 shout outs this week. Caught up with Joe Aston, which was great. That was last week, but it was a really good chat, and that's coming out soon. And caught up with the CEO of Aussie Broadband. That was a heap of fun.
My name didn't come up with Joe, did it?
Yeah, it's Dr. Andrew Derrimouth. He said, I've got he didn't say anything. He just pointed over his left shoulder, this big whiteboard. And then he had a photo of Dr. Andrew Derrimouth on there with a dart in it. So I was thinking, you guys, he called me, what did he call me? A gossip? Anyway, we should probably get on to some
waiting for my
questions.
cease and desist.
Get into some questions. Any of the questions that we do answer
I
on the
love
show.
his work, let's be honest. He
said,
whatever.
yes.
Can't wait to see what he does next.
Any questions that we do answer on the show are strictly general in nature. We don't know your needs, goals, or objectives. If you write into us, we actually ask you for a silly name. That's how you get read out on the show, because it just further anonymizes you and illustrates to everyone what we do here on podcast, which is general financial information only. If you give us a lot of your situation, we just simply will generalize it, not read that part out, keep it fun. If you need financial advice, seek out a trusted and licensed financial planner. You don't know who you can trust straight away, but the licensing is key. You can head to the moneysmart.gov.au website. You find someone like, say, Drew here on the website, and it will tell you what they specialize in. It'll tell you how long they've been a financial advisor. And crucially, you can make sure that they are indeed a financial advisor acting under a license. And to be honest, since 2019, with the introduction of the Financial Planners and Advisors Code of Ethics, can't remember the full name, basically, the whole entire industry has been massively cleaned up. And I always inserted in our general advice disclaimer, Drew, that you should speak to a licensed and trusted financial planner. I think, to be honest, we're at a point now in the industry, as long as you do the check and you make sure that they are a financial planner and they are on that register, the trust element is way up for me. So it is a full profession. It's code of ethics.
There are still some pockets there that more so that they narrow themselves down to something very specific. So they'll only recommend one type of asset or asset class. So that's the only thing I'd be wary of in financial advice these days. Make sure the advisor is suited to what you're looking for.
Yeah. And shop around. Most of them, if they don't offer like a free 15-minute or half an hour chat, you're going to trust them with one of your most important things in life. It's obviously health, family, and then wealth probably. Don't go with them. Simple as that. Warren Muppet, regular listener, I'm sure, writes in and says, I've just realized that my super provider is charging me 0.52% per annum in fees for a pre-built investment option. Are there any pitfalls to be wary of when changing investments to a passively managed high growth index or choosing a mix of my own? Well, that's, these options have lower fees, but do they carry higher risk? General advice for someone with long-term ambitions. I don't think 0.52% is that high, as long as it's performed pretty well over the long term.
Yeah, I mean now, so the Atchison and Waddell portfolios probably have an average of about 0.4 to 0.5. This is in management fees. So management fees, and most of this is paid to the fund manager of the 0.5. So it's not significantly expensive. The big one here is that when you're buying that pre-built investment option, you're buying, and this is where the higher cost will come from, it's usually got some unlisted assets in there. It's usually got some private equities, usually got some infrastructure, direct property, and these things
Melbourne
are more
Airport.
expensive to manage. Exactly. And you're paying for active managers to do that. You're paying for the investment team at this group to do it. Whereas as soon as you go to that passive option, you're literally just getting the index. You're getting the market cap weighted index for Australian shares, global shares, maybe infrastructure. You're not getting all that diversification benefit of unlisted. And we've kind of talked about in the past, if you're young and you've got 30 years, full index, you've got enough time to continue. You'll buy in the dips because you're forced to put more money into superannuation, so you get the benefit of cost averaging. But more and more we see people flipping the other way, whether it's within their super fund or to a more transparent approach when they get close to retirement, because they want to smooth that ride rather than roll with the market.
I think that conversation is a really important one to have in the lead up or in retirement. I'm not just saying that because that's what you do, but there is a growing chorus in our industry around those pre-built options in big super funds, like industry super funds, where they have unlisted assets. Like I wasn't joking before when I said Melbourne Airport.
Yeah.
Some of the big super funds own Melbourne Airport.
They're in every airport in the country, basically.
Yeah. So, and the biggest buildings you walk through, like Melbourne or Sydney or Perth, you'll see industry super funds slapped on the outside. They own the whole bloody building because they just need to put their money somewhere. But I think there's a growing chorus in our industry that the super funds are so big that they're having to do that because they've got so much money, they don't know where to put it, which may create issues in 20 or 30 years' time or even 10 years' time when
they've got no assets left to buy.
The super funds kind of go in reverse. They go from having to buy everything to having to try and give people their money because that's what the system's designed for in retirement. So I think as you get, to be honest, I think as you get towards retirement, start to think about maybe the standard pre-built option needs to be changed, and you do want at least to know where your money's going, as Drew said.
That's what we see a lot, to be honest.
Yeah.
And at the moment, contribution, young people contributing is countering the amount of people that are drawing pensions from their industry funds. For most funds, there's a few that aren't, that are the opposite. But eventually, and as the population continues to age, it's going to get further the other way. And in that case, you need more and more liquidity. You can't keep funding kind of unlisted and long-term investments.
Hopefully helpful mum writes in and says, my son has just completed his apprenticeship and as a gift, I want to set up some shares for him, ETFs, diversify. I don't know how much at all. How, if, can I do this? Is $500 enough? Well, anything's good. That's great, I think. Yeah.
Get started.
Yeah, just get started. But I would go to him, to be honest. I wouldn't just do it yourself and he'd be like, hey, you've got this money. It would be lost on him a little bit. I would use it as an excuse to talk to him, connect on his level, even if he wants to do something completely wild, like Bitcoin.
Yeah.
Maybe say we'll do, if it's $500, $200 in Bitcoin, and then $300 in these other stocks that you kind of talk about. But don't choose BHP, don't choose CSL. If he's a young fella, he's not going to be interested in that crap.
Get an ETF, either get a highly diversified ETF or get a thematic or something. Yeah, something he's interested in.
Or if you're going to pick a stock, pick Nike or, I don't know, Tesla or something that he's interested in. Because if it's $500,
maybe.
Lululemon, maybe, depending on your child. It's an apprenticeship, so I'm assuming he wears boots, not Lycra.
Hey, you don't have to wear Lycra at Lululemon. They have streetwear too. It's okay.
Oh, streetwear. Oh my gosh. How's the Lululemon stock doing, by the way?
Activewear.
Oh gosh. Brighton. Here we go. Lulu. How do you spell it? Lemon?
Lemon. Yeah, just lemon. Straight lemon.
Straight. Lulu is the stock ticker symbol. It's up 50% in 5 years. It's bugger all. Oh, it's up 10% after hours though. That's good.
Bet you it's doing better than Nike.
You reckon? You reckon Lululemon's doing better than Nike over what period? 5 years?
Last 12 months and 5 years.
Okay. Lululemon's up 50% over 5 years. Oh, yeah, you're right. Nike's down 19%.
There you go.
Wow. You called it. Okay. Yeah. Buy the Lululemon stock. No, but it's just good. It's a good opportunity.
We're going to a Christmas party this afternoon and we're playing pickleball. So it's all activewear this afternoon.
See how much Lululemon's in the crowd.
People call it activewear? I'm not sure.
No, I guess. You're talking to the wrong crowd, mate. I just dug this shirt out of the closet. Yeah. But I think that if you've got $500, don't treat it like this is going to be changing his life. Treat it like, as in the money amount, the opportunity to learn with you is what will change his life. So stick with that. There was a good question from Jedi Knight, which was just about changing super funds. And they said, what are the steps involved in moving super funds? It's super easy. You can just ask your new fund to pull the money across. It's called a rollover. That's that one. But the key thing with that is never change super funds until you've considered your insurance needs. Like seriously.
Yeah, insurance is key. Yeah. And making sure we actually answered this question on the Australian Retirement Podcast. I think that'll air in a few weeks' time. One is always consider your insurance, particularly if you've had some sort of medical history, because that usually won't transfer to the next group. The other one was the tax deduction here, that if you've made any after-tax deductible, like concessional contributions other than salary sacrifice, you have to claim those before you roll out of the fund. And then most importantly, make sure you're not just changing because of the performance. Fees is always the first thing to look at, but so many people just look for the hottest fund and go over to that. and make sure you're changing fund to something that's more, you're doing it because it's more appropriate for you. If that's a SMSF or a different industry fund or a platform, make sure it's appropriate and has what you want. You're not just doing it because you're chasing returns.
Bird shit or Birchal, question mark, writes in and says, and this is from, I think, my good friend. So interested to hear your thoughts on investing in companies listed on crowdsource funding platforms as a satellite position. Is it a good way to get exposure to early stage growth in startups and growing private companies? And how liquid are the shares once you decide to sell? I see that Birchal, which runs the crowdfunding platform, is using its own platform to raise capital. I thought this might be worth a look as they are licensed by ASIC and the industry appears to be growing in popularity here in Australia. A few things on this. One is we interviewed Matt Vitale, who's the founder of Birchal. So I'll put that in my show notes to add in here. That was only recently, so you can hear from Matt directly. It's a bit of inception that Birchal is raising money for itself on the Birchal platform. So figure that one out, Leonardo DiCaprio. But it is really interesting. These platforms are really interesting. I think satellite positions absolutely only because they're private companies, high risk.
Half of them fail.
Yeah, just be very mindful. It's great to learn about businesses and they're small businesses. They're great to learn. You could also just invest in a VC fund if you've got money. I don't do that, but if you have the means, that might be an option too. Conscious of time, we've got one final question here, which is actually not a question. It was actually just Claire doing our jobs for us. Claire wrote in and said, love the show. Is also a big fan of the call that's on Ausbiz, the portfolio, where two guests come in, talk about stocks, and then they go into a portfolio. Koshi presides over it like an overlord. No, he doesn't. I don't know what he's up to. But we are planning to run 2 fake portfolios in 2025. Maybe what we can have, Drew, is I was thinking about this.
We're doing 3 portfolios now.
I'm thinking 3 portfolios. We have the
listener portfolio,
the people's portfolio.
Yeah.
Then we have the Deramirth, whatever you want to name yours, and then my one. And what we can do, I think Claire said 40 positions would be best. I think that's too many.
Yeah.
Let's imagine it's 10 grand, Claire. 10 stocks. Max.
Okay.
10 positions max. We're going to keep it. It's high conviction.
All right.
This is going to launch on the 1st of January. So if you get
We're going to get a lot of miners. We're not going to do a lot of mining research in Perth.
We're going to boots on the ground, Perth.
Yeah.
Get your stocks and ETFs and funds in. We're going to track it using the Navexa software. So you have to be able to track whatever it is in the Navexa software. Chuck it in, right? Send it in the same way that you would send in a question to the show. You know that thing that says ask a question? Select the Australian Investors Podcast, put whatever gibberish you want to put in there, plus the stocks in the allocations. I'll get the everyone's together and we'll put that together based on what you say. And then we'll do the same one for our crazy portfolios and we'll talk about them between Christmas and New Year's and we'll start tracking the portfolios in real time.
I'm excited.
Claire did say some outlandishly funny stuff in here. She said the committee at Ausbiz missed the WiseTech dip because the day it was featured, they were both a hold. But what did she say? She said something that was like so hilarious in here. I thought that everyone would want to do it. It also gives punters exposure to lots of different stocks. That's not the one. Anyway, she said something like WiseTech was on the sale rack or something. And I love it, Claire. Absolutely love it. So thanks for doing our job. Oh, here we go. Love some cashmere on the sale rack. This is GQG. She was talking about here. So let's do it. Let's have a bit of fun on January 1st. Drew, you've got to take us off into the sunset with a joke, my friend.
Yeah, I reckon I've got an all right one this week. We'll see how it goes down.
Go for it.
I saw a radio on sale for $1 the other day. The sign said volume stuck on full. So I thought to myself, I can't turn that down.
That's pretty bloody good.
I take that one.
That's good. Well, enjoy your Christmas party today, son. And Claire, I think just the fact that you basically did our job for us in your question, you still need to give us some stocks though. You have won the Value Investor Program on Rask as well as a copy of Drew's book, The Golden Years, Don't Stuff It Up. No, just kidding. It's The Golden Years, something or other subtitle, but it's great. Some people in the community said it was great. So Drew, kudos to you, brother. Big 2024. Enjoy today. Thanks for listening. And we'll be back same time, same place next Saturday morning. We're getting close to Christmas. That means Christmas specials are upon us.
I love it.
Thanks for joining me, mate.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.